Welcome to Above the Noise. I'm joined by my friend Dan Hoeck, the Sultan of Securities.
And I'm joined by Aaron Rubin, the master of multiple choice. But really, he's actually a master of everything. He's got his CFP, CPA, he's attorney, and what else? Am I missing anything there?
Mortuary license.
Mortuary license, yes. So he's basically covered everything. But today, what we're going to cover is the FIscal Cliff. The good and the bad and the ugly. It's the legislative good in the bad and the ugly. So to start off, I'm going to start with the ugly. So we've gone over the cliff. Is it over?
Oh yeah. No, it isn't. Not even close. Congress took care of a couple things, but there's still a lot looming out there. The biggest ugly that's waiting for us in a couple months, sequestration. Trillions of dollars at stake. Trillions that potentially could be missing from GDP.
I'd almost say that's the bad. I'd say that's the bad. But that is a very big concern. What about the ugly? So what do we have now? We've gone over the cliff. We have the FIscal Cliff is now in place. Congress, actually Senate made a decision, voted. Congress approved. What are we looking at? Right.
The ugly part, it has to be the fact that millions of Americans are going to pay an additional 2% in Social Security. That's going to hurt. We've had this tax holiday where for the last couple of years, we've had Medicare rates be at an all-time low. Now those are kicking back up. That's about $2,400 a year for top-level earners. For those kind of in the middle, it's still going to represent about $1,200.
But this is something tackling everybody across the board. This is a 2% tax. Actually, just 2 years ago, prior to 2011, we had this tax in place. So we had a holiday, as you so eloquently phrased it, where we had a time where we actually were getting higher paychecks or more money out of our paychecks because we were receiving 2% more. And now we're basically reverting back to the way it was 2 years ago.
Right, we're reverting back. But again, that money that going back 2 years ago, that was money that was getting put back into GDP. I mean, that's money that people were spending on their Blu-ray players, on perhaps cars, any number of things. That's gone now. So again, that should be affecting GDP in the immediate future because people are going to start noticing that from their checks. It may just be a little bit. Maybe they don't know why their checking account balances aren't quite as high. But again, they're not going to be able to purchase those additional items that they've been purchasing in the last couple of years.
So we've seen a 2% boost. We are now seeing a 2% boost in Social Security taxes on our paycheck stub. The other thing we're looking for is actually it's for high net worth individuals, $400,000 that making $400,000 a year, $450,000 for a married couple filing jointly. We're seeing a boost in taxes there as well, about 4.6%.
Yeah, oh, absolutely. And again, those are the people that do invest the most in our economy. So I mean, again, you should see capital expenditures going down because that return on capital is not going to be as great. Now the tax calculation, when they go to figure out whether or not they should be investing in a particular product or human capital, hiring. Again, when they look at what it's going to do for their business in terms of future value, they have to discount that future value by a greater tax number than what they've had to do in the last few years.
So that potentially could affect us. That's why it's the ugly. These are just two of the items, Social Security and income taxes. These are two main items that are likely to affect most Americans. There's several others on the docket, but we have a few other things too. That's the ugly. The bad.
The bad. Right. No, and as I said, the bad has to be that we have 2 months of now negotiating in Congress to try to figure out the sequestration, and it's really unbelievable that they couldn't do anything about that now. And the problem is that now again, as investors, we're going to have to try to deal with the fact: are these couple of $1 trillion going to be out of the economy in a couple months?
Right.
That makes a big difference. And again, what do I expect? I expect volatility across the board.
Right. I can agree on that as well. We don't want to guarantee anything, but what we're expecting is we saw some volatility leading up to this FIscal Cliff itself at the end of the year. We still have more decisions to be made by Congress, so we can see that repeating itself. So we're not saying, though, at the same time, after the FIscal Cliff was the bill was passed, we then saw a 307-point jump in the Dow Jones. We saw actually a great day, which means investors are happy about this. 2% increase in Social Security, increases in income taxes. the market jumps. So actually, that's a really good sign. That's one of the really goods that come out of this.
Right, and I think, first of all, it's indicative of how the market appeals to stability. You know, stability is very important. And the fact of the matter is that 2 weeks prior, we had a really probably bad market in December, starting December 31st when the deal kind of started to form. Market went up, and then of course on January 2nd when they realized that a lot of this fiscal cliff had been avoided, again, the market had a good reaction. Stability, crucial, but I also think that was partially a market correction, kind of from an overreaction to a potential not having the fiscal cliff in those last couple weeks of December. But no, it was good for sure.
It was good. The thing is, we can't actually make a decision on what we're going to change about our investments. Bottom line is, even though we see this as a good day, and like you said, leading up to this day when we actually had a real rally in the U.S. stock market, it was pretty negative. It was a bit volatile, it was negative. We don't want to make any rash decisions right now. We don't want to change how we invest. We want to continue to stay with our plan. We don't want to make any bets, basically. And if we were to change how we invest today, we're really making a bet on what we think future legislation will be and how that's going to affect the market. So right now, we actually do want to stay steady, and we can be cautious, but we don't want to make any irrational decisions at this point.
I mean, when you take into consideration the bad and the ugly, I mean, America does have to be asking, in the words of Clint Eastwood, do I feel lucky, punk? Because it's a concern. But again, you do need to be disciplined in these times.
Yeah. Well, thank you again for joining us for our first edition, and we'll see you next time.